40 years is a long time. You're coming at this with a lot of market perspective at this point. I was very interested to read that you say in this environment, it's important to find reliable growers. Why is that? Give me some perspective about where we are and how you go about choosing.
You have no idea how long 40 years is, Contessa.
You started when you were 5.
I wish. Thanks, Tyler. I can always count on you.
Yeah.
So I think it's important to remember that when growth is slowing, and we know growth is slowing, and it's about to slow further, that investors then turn their attention to companies that can produce reliable growth. And many of those companies happily are also dividend payers and are growing their dividends. And I've been managing money in equity income strategies since the mid-1980s. So this isn't a fad for me. It doesn't always work, but dividend growth is, in our view, one of the best ways to generate excess return above inflation. So you want companies that have very high quality management. It's great if they are in the sweet spot of the secular narratives that are driving this economy, like productivity improvements via technology, like robotics, because wages are rising and workers are hard to find. But in general, this is not the time where you swing for the fences. This is where you look for reliable companies with strong management teams that can navigate and navigate the currents. And we saw some really good earnings reports in the third quarter, but they've been overshadowed by all the other noise.
Let's talk a little bit about what the esteemed Ray Dalio said in print. I guess he was in print in an interview, that the market could go down 20% if interest rates rise on the path that the Fed seems to be signaling. Do you agree that that kind of further decline from this level is possible or likely?
Well, anything's possible, of course. I'm not convinced it's likely. You've heard Jim Paulson talk about the time to buy stocks is when inflation is peaking, and he's right about that. And then if you look further and you go back and analyze the last 11 to 13 recessions, what you'll see is that more than half the time, stocks have been up in the recessionary period, and almost in every instance, 12 months later, they're up a lot. So I think it's important, again, this is why dividend payers are so important to a portfolio, because they do provide protection in a declining market, and they provide return, hopefully faster than inflation. So I'm not a good market prognosticator. I get it directionally where it's going, but I find that a lot of these predictions usually don't come to pass, and that it's somewhere in between. I think we've seen the lows. That's my view.
Interesting.
But it's just instinct, Tyler.
Okay. And you're very right. An awful lot of prognostications do not come to pass.
Yep. Some of mine, too.
Well, no, of course. I mean, that's the nature of the game. And we have a lot of people on. We fill a lot of airtime. We have 700 guests a week on CNBC globally. and you're going to hear a lot of talk. Let's talk about a couple of the stocks you do like. EOG, energy company, Chipotle, a different kind of energy, I suppose. L3 Harris Technologies. I almost said something different. Target. Take your pick. Which one do you like there? All of them, obviously, but.
Yeah, I mean, EOG Resources is easy. They're in the nat gas and crude oil space. They've had tremendous dividend growth, something over 68%, I think, 5-year annualized. And that's because, like all of these companies, they've changed their investment strategy to a capital allocation strategy. And so they've grown the dividend. They've had a $1.50, a $1.80, a $2, and a $1 special dividend just in the last year. This on top of their $3 regular dividend. So that's a great stock to put in the portfolio. And just let it do the work for you. In terms of Target, I mean, it's well above the lows we saw in June. This is one of the best managed retailers in the world, frankly. Dividend was raised about 20% last quarter, and it generates a 2.6% yield. So you're getting paid to wait for the consumer to stabilize and normalize. And then CMG just has proven they have pricing power.
Yeah.
They continue to raise prices. They continue to beat on earnings, and they're in the sweet spot of the digital narrative, and that's where you want to be.
All right, Nancy, always great to see you. Thank you for your time.